Hello everyone and welcome back to OGS. So we have been going through cash flow statements ever since we began this channel. So today we are going to go through the final cash flow statement before we move on to another financial document. So after this cash flow statement, we shall be going to loan repayment schedules, where we shall learn how loans are repaid to businesses. So today we have a number that talks about a cash flow statement. This should be final enough to ensure that you master cash flow statements, but I advise you to go back out there and look for other cash flow numbers that you can work out to get better in terms of projections and making business decisions. So, as we have been doing, we're going to start off with the business title. So this is Malcolm's cash flow statement for the months of January, February, March, and April 2024. So this is the final number of cash flow statement that I will be performing on this channel. So in the next video, I will be engaging into loan repayment schedules. So we're starting off this cash flow statement. We're going to have a column for details, a column for January, that's in shillings, February in shillings, March, and April. So we're going to start off with the very first transaction. It says that by the end of December 2023, the business expects a cash balance of 80 million Ugandan shillings at hand. So the business expects 80 million Ugandan shillings from the month of December. So this is going to be recorded as balance brought down. So our balance brought down from December is 80 million Ugandan shillings. So we're going to move on to the next part of the cash book, that is cash inflows. Yeah, as you remember, we said a cash flow statement has two parts, cash inflows and cash outflows. So the very first cash inflow is the business is to receive rent income for 8 millions in December 2024. But this is to increase by 1,500,000 Ugandan shillings monthly. So what this means, it means by the month of December, the business is to receive 8 million. And that means in January, we're going to add 8 million plus 1.5 million to obtain the amount for this month. And we shall keep adding 1.5 million to obtain all the amounts for the next month. So this month is 9.5 million, the next month is 11 million, and in March we have 12.5, and in April we have 14 million. So that is the very first cash inflow as rent income. That is the first transaction. So we move on to the second transaction. The second transaction says monthly cash sales are projected at 40 million Ugandan shillings and are to increase by 5% after the first 2 months. So in the first 2 months, the monthly cash sales are 40 million and 40 million, and when they do increase by 5%, there will be 42 million and 42 million in the month of March and April. So 40 million for January and 40 million for February, then March and April 42 and 42. So moving on to the next transaction. The next transaction is monthly credit sales. So monthly credit sales is our sixth transaction. So as you can see, we have put in the third transaction as monthly cash sales 40 million, increased by 5% after the first 2 months. So when you look at the next transaction, the fourth, it's the business is to buy goods on credit, but that is a cash outflow since it's purchase on credit. It's a purchase. So the fifth transaction says monthly cash purchases, so that is also a cash outflow. So we don't record that in this stage, in this stage of the cash flow statement. So we move on to part 6. Part 6 will come and say monthly credit sales are projected at 70% of each month's cash sales. Debtors are to clear 80% of the amount in the month of sale and 20% in the following month. So what this means, it means the monthly credit sales are projected to be 70% of each month's cash sales. So we're going to pick up our calculators and calculate 70% of the cash sales of each month and record those values aside somewhere. So those debtors, the people that owe us that money, they are to clear 80% of the amount in the month of sale. So within that very month, each of those very months, they clear 80%. So they pay 80% of the money they owe us. So we are going to calculate 80% for each of those amounts we obtained as credit sales. So it says that the debtors are to clear 80% of the amount in the month of sale and 20% in the following month. So after us obtaining the 80% values, we are going to carry on the 20% values to the next month. So we shall be adding. So for the first month, you're going to get the credit sales. After getting the credit sales, you're going to get the 80% they paid, and then you carry on the 20% to the next month. So for the next month, you're going to get the credit sales value and then the 80%. Then you're going to add that 80% plus the 20% that you've just received from the month of January. So for March, we shall repeat the same thing. For April, we shall repeat the same thing, and we ensure that we do not forget to add the balance that is being paid from the month before. So we expect values to be similar for the first 2 months and to be similar for the next 2 months. So these credit sales should amount to 22,400,000 for January and 28 million for February, and then 29,120,000 for March, and finally in April it should give us 29,400,000. Those will be our credit sales if you calculate them correctly. So it's just a matter of following the word problem in the question. You first get how much the credit sales are, then you get how much is paid, then you get how much is transferred to the next month. So I think I'll do it for you. So our transaction is credit sales. So our very first credit sale is 22,400,000, as I said. The next is 28 million. And the next is 29,120,000. Of course, a calculator is very crucial at this stage of the cash flow statement. So 29,120,000. Just hold on a minute. So 29,120,000. So for the next month, it should be similar. So that will be that will be 29,400,000. So those are our credit sales. So we are moving on to the next cash inflow. So the next cash inflow is loan acquired. So when you look at this, the next cash inflow is the business is to acquire a loan in January worth 30 millions at a monthly interest rate of 2% on a fixed balance method. The principal is to be paid in 3 equal monthly installments effective February. So right now, what we have to write is the loan acquired, the loan value. In the coming video, I will be teaching you how to work out loan repayment schedule so that you can learn how how money that is obtained as a loan is paid back and how it can be put into the cash flow statement. So our next cash inflow is the business is to dispose of an old motor vehicle in the third month worth 3,500,000. So in the third month we write 3,500,000. So we move on to donations as our last cash inflow. So this part says the business expects to receive donations monthly amounting to 10% of the cash sales. So you get 10% of cash sales every month and you fill it in as donations for every month. So that part is done. Our cash inflows are complete. So we are going to find the total cash inflows. We're going to put it on the table. And then we shall move on to the next part of our cash flow statement, the cash outflow. This is a very crucial part of a cash flow statement. It shows how much money is moving out of the business, which item or which activity took out money from a business. So, moving on. Our very first cash flow is goods. Cash outflow will be goods sold on credit. So the business is to buy goods on credit in January. This is the fourth transaction. The business is to buy goods on credit in January worth 50 millions and payment is to be made in the ratio of 50% to 25% to a quarter. So beginning with the month of purchase. So this means that the business bought goods worth 50 million